All right, and we're live. Welcome to Chasing Alpha for another fantastic video. My name is Rod.
And I'm Dean.
How's it going, man? You're
What's up?
good?
Yeah, I'm good. How you
Oh,
been? How you been, Rod? Good.
man, I am good. I'm really pumped about today's video. We've got this, how do I say it? How to,
How to grow your portfolio without investing any further capital?
yeah,
Without
how
no
to
money.
grow your Bitcoin without putting any more money in. It's
Magic.
almost like magic.
Magic.
It's like magic. We have got the almighty magician over here. So without further ado, let's just get into things. Let me just uh, get my screen shared over here and we will get right into it. So what exactly are we talking about here, Dean?
Right. So we'll be talking about how we can. What's really looking at dollar cost averaging, and then comparing dollar cost averaging with a new kind of structure, or how you can structure your investments is called collateralized reinvestment plan. So it works similar to the dividend distribution, dividend reinvestment plan, where you take your dividend and basically the company that pays your dividend reinvest it back to the company for you, or they give you more shares instead of a cash payment. So we'll be looking at that, but collateralizing your existing assets in your portfolio to basically invest more of a certain type of asset or anything really. So let's get into it.
Excellent. So what are we looking at here?
So the first option, we've got two options here. The first one is traditionally when you buy one Bitcoin, you start with one Bitcoin and you hodl it, or you can trade it. So if you were to hold it and you buy it at 10,000, you hold it, gets it to $15,000, you earn the money, you made $5,000, and you wish to. So what are you going to do with it? You're going to cash out, take 35% out. You take out 5,250, and your final balance is 0.65 BTC. So actually, it actually reduced your portfolio value in terms of BTC units. Or you can hold and not take any cash out, and you still have one BTC. And the price dumps, you still go one BTC. It doesn't really matter. You got one unit. Whereas option two, you got here collateralized in a reinvestment plan. Kind of slow it down a bit. Start with a one BTC at 10K, and it pumps, say, to 15,000. And say that you want to collateralize that one BTC, and you borrow, 35%, right? So you have 5,250 to reallocate to any investment. Let's say you want to reallocate it to BTC. But while you're deciding where to put it, the market dumps, right? So from 15,000 down to 12,000. Great, you can actually buy back utilizing your $5,000. You can buy back 0.438, almost half a Bitcoin, utilizing that amount that you borrowed, that loan. And it'll give you a final balance of 1.438 to BTC. So you almost, got another half of that BTC from just not putting in any further capital, not opening your wallet, not doing anything. So let's say while you're deciding, the market jumps up again. So it goes to 18,000. No worries, you can buy back 0.292 using that same $5,500 or $500,000, and your final balance would be 1.292 BTC. So you can see that irrespective of which direction the market heads, your investment plan or reinvestment plan could be totally agnostic to what the market is doing. So you don't have to worry about what's going on. You can just keep reinvesting.
So can I ask you a question here, Dean? Because I'm sure many of our viewers, like myself, have always looked at option one. You've got your one Bitcoin and you're holding, and it goes up in value. Like, oh, fantastic! It's gone from was it 5, 6, 7,000? It's gone to 10,000, then all of a sudden to 13, 14,000. But obviously, as we know, it dumps and it goes back to 9 or 10,000 as an extreme example. So we've still got one Bitcoin, but we haven't really taken any advantage of the market. So what you're saying here is that by putting our Bitcoin into Nexo, we can actually take advantage of whether the market decides to pump or dump. We can still come out on top by increasing our Bitcoin holdings.
That's right. So if your plan is if you're a long-term hodler like us, right, and say, I'm not going to cash out until the market's, matured, or, the bull market's matured in a year or two's time, when the Bitcoin is, say, 30, 40, 50 grand, then I'll cash out. So your current, goal is to get as much Satoshis under your belt as possible. So stacking the Satoshis, you probably heard about it on Twitter and all that. So that's what we're trying to do. Trying to basically just grow our portfolio, whether it be more Bitcoin. You don't have to buy more Bitcoins. You can chuck it into Ethereum or other altcoins as well, because the collateralized, the amount that you borrow is actually a US dollar tether or another stable coin. So you can essentially deploy it to anywhere else. You can even buy gold bullions. You can either buy stocks, whatever you want.
Nice, very cool. All right, so what would be the considerations that we need to look at before investing in Nexo?
Of course. So this is what we always look at, and kind of tell you that there's always another two sides to a coin. And when you're going down this route, you got to be very, very mindful that what's the kind of underlying assumption or consideration that the market that you should be working this collateralized plan. What kind of market that's favorable? So obviously this works better in a bull market, because if we were to get in at January, February, one Bitcoin and at 10,000 or 8,000 and dumps to say 3,000, essentially it's more than, you almost would be at that liquidation threshold. So if it's a bull market, like we're in the cusp of a new bull market, right at the bottom of it, it's a perfect opportunity, because the market, we're getting higher highs and higher lows. So it works better in a bull market or uptrending market. The next one is the LTV, which is loan to value ratio, and we've got it as 35%, which is a prudent threshold. We don't want to have to take any more. So the loan to value ratio is like basically how much you're borrowing versus what the total portfolio valuation is. So if you were to collateralize one Bitcoin at 10K and you borrow $3,000 or $3,500, your LTV is 35, because you're borrowing 35% of the total portfolio. An interest rate we assume is 8%. So the APR that a lot of the lending companies will be a lot more than that, maybe, but 8% is what we use as the preferred lender that we've gone with, which is Nexo. They're charging 16% per annum, but if you pay back utilizing Nexo tokens, you actually get half. You get 50% discount, which is massive. The margin call. So if your LTV rises past a certain threshold, you could get margin call, which is obviously a concern, and it's a big risk. That's why we always recommend not over leveraging. So the margin level here is 1.1. So your total valuation must be 1.1 times the amount that you borrow. That's the maximum, all right? So, or the other way of looking at it is, when your loan becomes 85 to 90% of your total valuation, that's when you have a problem. Maturity is one year, so which the Nexo gives you up to 1 year to pay back your loan. You can extend it upon negotiation, but just so for our exercise, we'll be working with 1 year time frame. Loan withdrawal, as I touched on earlier, is US dollar tether, and you can withdraw it instantly as soon as you deposit the fund into your account. And it's really important to have a backup plan. You should have some funds aside just in case you need to top up your margin account or your lending account, just in case you don't want to be liquidated. So it's always good to have backup, because the market might come down and you might need to top it up, and it'll sure enough will go back up again. So you can always take it out when it goes back up. So no worries.
So what we're saying there is, don't put all the Bitcoin that you have in this, although yes, it is quite a good setup. If you don't have any money to pay back when you need to, if the market did dump on a major scale, then you're only going to end up getting margin call, and that's where a major issue could be. So what's this DCA that we're looking at here, Dean?
So this is the dollar cost average method. So a lot of people in the crypto community specifically go by this. They swear by the DCA method, where you chuck in consistently an amount per week, fortnightly or monthly. So it slowly builds up your crypto holdings over time. The problem is, though, if the market's rising, the amount that you actually get, the amount of Satoshi, the amount of cryptos you get, also it reduces, right? So say that today's at the all-time low. If you had on all the cash in the world, you're better off buying it today. But because we can't time the market, people DCA. It also helps helps to kind of control your behavioral biases. So that's why the discount DCA method is really, really good, and we actually do it ourselves. It's a very prudent way to get into the investments. And we're going to be comparing DCA versus the collateralized. So DCA, you're having to put money in. And a lot of times you might not have spare cash coming in, like highlight $500 every month. So you can see the Bitcoin price rising per month over the next 12 months to $18,700. And if you chuck in $500 per month, you'd have a total DCA value of $6,000, which is 0.45 BTC. And at the end of the year, you'd have a total BTC value of 1.448. So just almost 1.5. And a total valuation of 27,000. So we're going to compare this with the collateralized reinvestment plan.
Perfect.
So as you can see, similar situation. The Bitcoin price, is every month it goes up about 5% per month. Inflation, which is not a heck of a lot. And if you were to reinvest, so you've got the first at 35%. So each time it goes up, it unlocks a little bit of excess loan-to-value capacity, and that's where you reinvest it from. So you're always keeping the loan-to-value ratio at 35 or around that 30% figure. So if you look at the running total debt, including interest, you borrow at the end of the year about approximately $11,000, almost just under $12,000. And the loan interest, you'd be paying around, I can't see the figure, $600 approximately, should be. And running
$7, I think.
Yeah,
correct.
600. Yeah, it should be 607. I can't see. There's like a little cursor there on my side.
Is it gone now?
No, that's fine. That's cool. I think I remember $600 something.
Yeah, $607 it says.
Yeah, which is not a heck of a lot amount. It's not that much. The running total value of Bitcoin, you have around 1.93 approximately. And it shows you the portfolio valuation at the end of that year of 36,000. And the key thing to be looking at is the equity. So this is the amount less your portfolio value less the debt that you borrowed. So at the end of the year, 24,000 based on 18,000 value, 18,000 per Bitcoin price in 1 year's time. Now bear in mind that we're going to be heading towards the Bitcoin halving situation next year. It's 2020 in May, I believe. So it might be a lot more than the price might be a lot higher than that, which should actually increase the equity and your portfolio value as well. But for this scenario, we've actually utilized 18,000 as a conservative base. As you can see as well, your debt to asset ratio is 32%.
Okay, so a couple of questions for you, Dean.
Yep.
So what we're talking about here is investing, let's say, one Bitcoin. Let's say we do it today. What's the price? I think 10,100, 200, something like that. Mm-hmm. So by investing in the collateralized reinvestment plan, we're going to come out at the end with a running total of 1.936 Bitcoin. Now, your estimate of 18.7 for Bitcoin in a year's time, I mean, it could be bang on, but we're obviously hoping it's going to be a lot higher. So what it does mean is that the equity figure that we have of 24,500, that in particular could be much, much higher. So you still have the same Bitcoin amount, but you may have made a lot more capital gain there by doing something like this. With the halving coming up, we're expecting that figure to be at least quite a bit higher sometime before the 12 months is up. So we do think that this could be a lot higher. However, we're just giving some conservative numbers, very, very conservative numbers to start us off with.
Absolutely, that's right.
Yeah, nice. So what's the last method that you've got here, Dean?
So this is a hybrid combined method. So this is combining DCA. So if you were to say, no, I'm going to be good doing I like the DCA, but I also would like to explore what the collateralized reinvestment plan has or could do for me, then this is perfect because you can actually combine your DCA at $500 a month or whatever it is per month, plus the reinvestment plan, and it will give you your portfolio valuation a lot higher than you'd using any of those structures by itself. So if you were to do DCA by itself, you'd have a lot less than you utilize the CRP and DCA, obviously. So if you can look at the last column, the combined total valuation of your portfolio would be 32,000, almost 33,000, as opposed to DCA alone would be 27, and CRP alone would be around 4, I think we touched on last time.
Yeah.
Yeah, so as you can see, it's and I've actually, there's a big visual representation. There's a bar graph next slide if you put that on, so you can see there. The gray is the DCA, the blue is the CRP method alone, and the red is the combined effort, so hybrid method, so CRP and DCA combined. So you can see you can maximize your portfolio value and your wealth by utilizing this method.
Absolutely. And if like us, you believe that the price of Bitcoin is going to be quite a bit higher, I think we've made a video where we believe that it should be somewhere around, I think it was 40 to 45,000, was it, by next May? From memory?
By next May, I think we touched, it was around this figure. So we said between 14 or 15,000 to about 18 to 20.
Okay, all right.
That's where we got these figures from. Yeah,
I must be dreaming. Probably been looking at.
Yeah, I mean, even in that particular scenario, we're also also conservative, because it's better to give the not the best case scenario at all times, but more likely and a conservative scenario.
Yeah, absolutely. So all right. So let's have a look at the next slide. What have we got here, Dean?
So this is the question. So Nexo or DCA, and you don't have to choose. These are not mutually exclusive. You can go for both, and personally, I've been using both, and it's been working well. I took out the funds, had I left it just in BTC, that'd be sitting in BTC. I took some funds out, collateralized it, and I'm getting involved with some IEOs with Binance Launchpad, just giving that a go, see how it goes. And by the way, the last month IEO turned out pretty good for us, and our group is doing well so far. So I recommend all viewers to join our group, Telegram group. The link is below. Also, the DCA works better in a falling market, I should mention, because like I mentioned earlier, if your dollars are able to buy more when you buy the dips, obviously. When the market's up, you can utilize the collateralized reinvestment plan, so you can get so you can actually play the market that way. And again, just to reiterate, the combined approach will maximize wealth creation.
Nice. So what are the benefits of Nexo?
So better cash flow, obviously. So you can utilize your funds to buy other assets, which might be more might have a better potential in the short term. And the biggest thing is the optionality. What I mean by that is that you can actually allocate the funds to, say, a particular stock if you wanted to. The collateralized funds, I mean, you can allocate the stocks to gold, to the funds to gold bullions. Gold had a bit of run up recently. You can allocate it to some of the altcoins, which might boom anytime. So any given day, any of the altcoins are up 30-40%. So you can actually utilize these opportunities.
Nice.
So that's the optionality is the key thing here. Also, the other benefits of Nexo is you can utilize you can reduce your cost of capital by half, as we touched on, right? So 16%, and you can pay back with Nexo tokens. You can pay back 8% as the APR, the interest rate. And if you were to buy tokens today, for example, it's trading at 7.5 cents, right? When they have dividends, the Nexo is a security token which gives you dividend distributions. You can actually get back up to anywhere between kind of 8 to 12% dividends, which again will reduce your cost of capital. Also, if you hold the token, you buy it at 7.5 cents and it goes to 10 cents, that'll reduce your cost of capital again. So you're actually paying back less than what you actually borrowed, which is quite a neat little trick.
Mm-hmm.
This is the best way. This is a really good way to for efficient asset allocation and wealth creation.
Nice. And can we just add in here as well that, look, we are going to look at the tokenomics of Nexo as a coin, or sorry, as a token to invest in. We think the company's got a lot of good things going for it, but we'll explain that in the next video. One of the benefits of Nexo would be, well, they're hoping to launch some sort of a Visa, or is it a MasterCard, that's already been approved by the SEC. There's a lot of things going on. So in our next video, we're going to look at the tokenomics, and we've got some really exciting updates on Nexo. So just moving on, Dean, what are the risks? As anything is always a risk, but what are the risks here on this one?
Yeah, so the first risk that I can see here is the over leveraging. So if someone goes crazy and said, I'm going to borrow up to 50%, max out my capacity. If it dumps more than 50%, you'd be kind of stuck in a hard place. it has to top up your account, which would be not good, not ideal. The second one is Nexo is centralized. So if there was a hack, even though I should mention they're actually fully insured, insurance backed, so your funds are safe. However, even though the funds are safe, if they get hacked, there's a bit of time where the remediation procedures will take time. So, there's still a risk there. The loan repayment is 1 year, which is a concern, and you can always extend it. But at the end of the year, hopefully, you better have some funds to pay back your loan. So that's one of the risks. The market might be going through a dump, for example. Then you kind of be stuck to pay off the loan. So you got to make sure that you can manage that properly. And also our strategy is banking on the fact that the price of Bitcoin will appreciate over the next 12 months. If it doesn't, well, then obviously we'll be not in a better situation, but hopefully in the same situation, and hopefully not in a worse situation. But we have reason to believe that the Bitcoin price will have a steady increase into the next bull market. So I'm pretty confident on that one.
Absolutely. Oh, well, thank you, Dean, for another very informative video. That brings us to the end. Look, we'd love to hear your feedback. Did you like the video? Was it no good? Give us some feedback. So please do subscribe to our channel. We do have regular videos coming out. We've got a whole lot of great content coming up. We would also love for you to join us. We have a Telegram group where we are releasing pics and signals and things that we think are happening within the crypto space. Any final words from you there, Dean?
Join our Telegram group chat with our announcement channel, and also a discussion channel as well. We're going to be launching a website as well, and subscribe there, and please subscribe to our YouTube channel as well. I'm doing this full time now, so I've left my job at the institution, the financial planning firm. So we're going to be bringing you just full-on crypto and investment news and upcoming information, tips, and how to basically maximize wealth creation. Join us and ask any questions and keep in touch.
Absolutely. Hey, look, thank you for watching. We'll talk to you again next time.
Peace out.